Now let's learn how to account for merchandising purchases. On February 1st, ABC Company purchased $1,000 of merchandise for cash. That should say not 1,000 units, but it should be $1,000 of merchandise for cash. Let's take a look at how we record this transaction. What are the accounts affected by this transaction? It's going to be inventory and cash. Inventory is an asset. Asset increases when we purchase inventory, so we're going to debit inventory for 1,000. Cash decreases because we paid cash. Cash decreases. We're going to put cash on the credit side. So your journal entry is debit inventory 1,000, credit cash 1,000. How does this change if instead of paying cash, we bought this on account? So what if ABC Company purchased $1,000 of merchandise on account? Then we would be debiting inventory for 1,000, but crediting accounts payable for 1,000. Whenever a merchandising company buys products, there are certain discounts available to them. We're going to take a look at two different types of discount. A trade discount. A trade discount is when a company buys in bulk, they're typically given a large discount. The trade discount is not accounted in the books of the purchase. So assuming we are the company that's buying and we are getting a discount, we're not going to record that in the books. What's going to be recorded is the final purchase price. If you remember, going back to the cost principle says that we record assets at the price we paid for them. Again, trade discounts are not going to be recorded in the books. Only the purchase price is going to be recorded. There's another kind of discount called the purchase discount. Purchase discounts are offered when companies buy on credit. Let's take a look at an example. Let's say on February 1st, we purchased certain items on credit. When we buy on credit, the supplier or the vendor gives us a certain amount of time to pay the invoice. Let's say that the supplier gives us 30 days to pay the invoice. This 30-day period is called the credit period. That means we purchased on February 1st, we have 30 days to settle the invoice in full. Now, in some cases, the supplier will give us a discount if we pay early. Cash is important to a business, so the supplier would like to get paid as quickly as possible. So if we can pay the supplier early, they will give us a discount, and we call that a purchase discount. Let's assume that the supplier will give us a discount if we pay within 10 days. This 10-day period is called the discount period. So, to recap, the credit period is the full 30 days that the supplier will give us to pay. That within that 30 days, we have to pay the entire amount of the invoice. But if we decide to pay earlier, within the discount period, we will get a discount of a certain percentage. Now, we bought this material on February 1st, and we are given 10 days, which is our discount period. If we pay within 10 days, we get the discount percentage. So 1 plus 10 is 11. If we pay on or before February 11th, we will get that discount. In industry, purchase discounts have a particular way that they're stated. You're going to see a purchase discount written out this way. This would be 2, 10, and 30. Let's take a look at what it would mean. The first number, the 2, is a discount amount. So 2 means you're going to receive a 2% discount during the discount period. The second number, the 10, is the discount period, which is 10 days. So you get a 2% discount if you pay within 10 days. The N stands for net amount of the invoice. So the remaining balance is the net amount of the invoice that needs to be paid within 30 days. The 30, the last 30 right here, is your credit period. So 2, 10, and 30 means 2% discount if paid within 10 days of purchase, or the remaining amount of the invoice is due within 30 days. Let's take a look at an example. It says on March 7th, ABC Company purchased $1,000 of merchandise on credit. The terms were 5, 10, and 30. Then on 17th of March, ABC Company settled the amount due for the 3/7 purchase. First, let's go ahead and do the transaction, how we would record it on March 7th. On March 7th, you know that the accounts affected by this transaction are inventory and accounts payable. Inventory is going to be debited for $1,000 and accounts payable is going to be credited for $1,000. Next, let's move on to March 17th. The first thing we need to do is to check whether March 17th is within our credit period or not. So let's see. We purchased these items on the 7th and we are given a 10-day discount period. We are paying on March 17th, so 7 plus 10 is 17, and March 17th is within the discount period, so we are good. We will receive that discount. The next thing is to calculate the discount amount. You know that the discount is 5%. Remember, the 5, 10 means 5% discount if we're paying within 10 days. So we receive a 5% discount of the invoice, which is 5% of $1,000, which is $50. That is the amount of the discount. Now the next thing to do is figure out how much are we going to pay. Are we going to pay the entire $1,000 that we owe? No, we're going to subtract the discount of $50 and we're going to pay cash of $950 to our vendor. Now let's go ahead and record the transaction that occurred on the 17th when we pay the vendor. So what are the accounts affected by the transaction? There are 3 of them. We know that we're going to pay cash of $950. So you can draw your T account for cash, and we know that when we pay cash, cash is credited. So we're going to credit cash for $950. Next, we also know that after we pay this $950, we're not going to be owing anything to our vendor. So we need to bring this balance down to 0. So we are going to debit accounts payable for $1,000, bringing the balance that we owe to the vendor to 0. Now you got a cash credit of $950 and a debit on accounts payable of $1,000, but your account's not in balance, or rather your journal entry has $1,000 in debits, only $950 in credit, so you're short $50 in credit. That $50 is your purchase discount. What you're going to do is that $50 gets credited to inventory and goes towards reducing the overall cost of your inventory. So the final cost of your inventory is going to be $950 because you took advantage of that purchase discount by paying early.